Good afternoon. My name is Karen Artis-Sanchez. Welcome to Wilkin & Gutton Plan's webinar, Strategies for Reducing Your 2016 Tax Bill. Today's webinar will focus on ideas and strategies for individual taxpayers. For those of you interested in CPE credits, as you know, it's important for you to answer all of the polling questions as verification so that we can process your CPE certificates. You will also be emailed an evaluation form after the webinar, which you'll need to complete and return to us. Upon receipt of your completed evaluation form, we will send your CPE certificate via email. This webinar is being recorded and will be available for download on our website, which is www.wgcpas.com. Our speakers today are myself and Lauren Landolfi, a manager with the firm. Lauren's going to start the presentation, and we will discuss the agenda, and then she'll take us through the presentation. As I mentioned, all the housekeeping, there's questions, there's a panel or a pane on your window where you can submit questions, and just make sure that you answer all of the polling questions. With that, I'm going to turn it over to Lauren.
Thanks, Karen. So today we're going to first start off with an overall tax structure, just so that you can get a sense of how our U.S. tax system works. Then we'll go into the meat of our presentation, which is our individual tax planning topics and ideas. And then Karen will round it out at the end with some business tax planning suggestions. So first, let's start with our tax structure overview. So in the U.S., we have a few systems of tax that kind of are completed at the same time. And so it's not just as simple as saying you have, X tax rate. And so the first one we're going to talk about is our regular tax. Our regular tax is a graduated tax system. The regular tax rates are a range of 0% with the top rate at 39.6%. And it's a sliding scale. So as your income increases, so does the rate of tax you pay on that higher income. So you get the benefits of the lower tax rate, and then as you get into the higher taxable income dollars, that's when these higher income tax rates come into play. The character of income impacts what items are subject to this particular regular tax. Another type of tax we have is our capital gains tax. So this, in certain instances, is a preferential tax rate. For our short-term capital gains, so these are going to be items that are held for less than 1 year, we are not going to have any tax preferential rates. So those ordinary income rates that we were talking about on the previous slide, those will apply to any short-term. Now, when we're talking about long-term, that means over a year. And long-term capital gains, so investment property, for most taxpayers, that's going to be stock. Those that are held for over a year are taxed at favorable rates, and the tax rates are 0%, 15%, or 20%. And what rate you pay depends on what your regular income tax bracket is. So for our low-income taxpayers, those that are in a regular 10 or 15% bracket, they don't pay any tax on long-term capital gains, and those taxpayers that are in that highest rate, that 39.6% bracket, they pay the maximum 20%. And everybody else that falls in between, they pay a 15% long-term capital gain tax rate. Now, the other thing that's happening while we're talking about different tax rates and different tax structures is our alternative minimum tax. And this is something that a lot of taxpayers are probably familiar with the concept or the term, but we'll go into a little detail of what it actually is. This is a calculation that happens parallel to our regular tax calculations. The difference between AMT and regular tax is that it's either a flat 26% or 28% rate. So instead of having that graduated sliding scale, we're at a flat tax. And for purposes of the alternative minimum tax, or AMT, alternative minimum taxable income, so the tax base is often different from the regular tax base. And we'll go through an example of how that calculation actually plays out. So some of the differences, for income that is subject to the alternative minimum tax but not regular tax, incentive stock options, and very commonly tax-exempt interest from private activity bonds. So these are items that are not income for regular tax purposes, but are income for AMT tax purposes. So we have an unfavorable adjustment. We have higher income for our AMT tax base. The other side is we have deductions that are completely disallowed for AMT purposes. And you'll see this chart up on the screen. There are all of these itemized deductions. We're going to go into most of these in detail as we continue through the presentation, but they're all allowed for regular tax purposes, but many are completely disallowed for alternative minimum tax purposes. And you'll notice the big ones. Up in the Northeast, we have high income taxes, high real estate taxes. All of those taxes are completely disallowed as deductions for AMT purposes. The other thing is unreimbursed employee business expenses, also something kind of common, completely disallowed for AMT purposes. So let's work through an example quickly just so that you can get a sense of how this works. So we have a taxpayer who has income of $300,000 in the form of wages, and they have exercised $50,000 of ISOs this year. As far as their deductions go, they have $20,000 of mortgage interest, $20,000 of real estate taxes, and $10,000 of state income taxes. So right off the bat, you see that our income for regular tax purposes is lower than our AMT income. And that's because those ISO options that were exercised are going to be added back. That's income for AMT purposes. In addition, we have deductions for regular tax purposes that are higher than our AMT tax deductions. And you'll see that there's a $30,000 difference in deduction, and that's those real estate taxes and state income taxes that are being disallowed. So our taxable income, there's an $80,000 $80,000 difference, as you can see, between regular tax base and our AMT tax base. The tax rate, we're using an assumed effective tax rate of 23.5% for regular tax purpose. So this is considering the blending of all the rates and the graduations. For AMT, this person, this individual would be in the 28% tax bracket. So when we do this parallel calculation, we come to almost $60,000 of regular tax and over $92,000 of AMT tax. And I know that many of you would rather pay the the regular tax, but the IRS and the government dictates that you'd pay the higher of these two calculations in this case. The other thing that I wanted to know is that as our regular income tax rates have gotten so high because they're all the way up to 39.6%, we're seeing a lot of taxpayers or higher income taxpayers actually come out of AMT who historically have always been in AMT and become just a regular taxpayer, you know, and not subject to alternative minimum tax. And for a lot of people, they get kind of excited when they hear that they're not in the AMT anymore. But the reason that they're not in AMT anymore is because that would actually be a lower tax amount. When we have a top tax rate all the way up at 39.6%, most people would prefer to pay 28% that AMT rate over that 39.6 regular tax rate. So just within the past couple years, we've kind of seen a shift. So just a little explanation of why that is. Okay, so now we're going to go into our first polling question, and the question is required if you are looking for CPE today to show your attendance. So the question is, taxpayers will pay the lower of regular tax or alternative minimum tax? This is a true or false question. We'll give you guys a minute just to answer this question. I'm just going to give you a couple more seconds, and then we're going to close this down. Remember, if you're looking for CPE today, we're going to need you to show your attendance by answering this question. Okay, we're going to close it down, guys. And everyone, this is false. So the taxpayers are going to pay the higher of the alternative minimum tax or regular tax. Okay, so the last tax rate we're going to talk about is our Medicare Surtax. And for a lot of people, this is more commonly referred to as the Obamacare tax. This Medicare Surtax is a two-pronged tax that's on both earned and unearned income. Now, the earned income is a 0.9% tax on wages and self-employment earnings that are in excess of these thresholds that are on the screen. So for taxpayers that are married filing joint, the threshold is $250,000. Taxpayers that are married filing separate, it's just half that, so $125,000. Any other filing status, so single, head of household, qualified widower, that's going to be a $200,000 threshold. The one thing to note is that employers are not required to consider your spouse's earning when they're doing this withholding. So for a lot of taxpayers that are W-2 employees, once you exceed the $200,000 threshold, your employer automatically is going to start withholding this 0.9% to account for this tax that you're going to be liable for. But for many taxpayers, they may be making $200,000. They have a wife, husband that's also making $200,000. So in total, their income is $400,000. It clearly exceeds the $250,000 married threshold. But because individually the husband and wife did not exceed the $200,000 single threshold, the employers are not going to withhold for them. So it's not generally a huge dollar difference, just something for people to be aware about. If you are in that situation, you may need to just make some estimated tax payments to catch up for that shortfall. So just something to note. So the other half of our Medicare Surtax is the unearned income piece. And this is a 3.8% tax on the lesser of our net investment income over the thresholds. And the thresholds are the same as the previous screen, so the 250, the 125, or the 200, depending on your filing status. And for unearned income, this is really going to be any investment income, so interest, dividends, annuities, rents, royalties. If you're an investor in a partnership, any passive income that you earn from that business. All of that is going to be considered as investment income. It's not going to include any IRA distributions or Social Security. That's all excluded from this. And this screen, this just really puts a little more color as to who is paying these Medicare Surtax rates. So you'll see the first level of numbers. These are for our taxpayers that are earning income that's under the threshold. And you'll see the Medicare tax rate on earned income is 2.9% for these taxpayers. So this is the Medicare tax that has been in the law for a long time. So this is the portion, that 1.45%, so half of that amount is paid by the employee and half of that amount is paid by the employer. So there's been no changes there. Those taxpayers that are under the threshold, they don't pay any tax on their investment income. It's once you exceed the threshold, that's when that 0.9% comes into play for earned income and the 3.8% comes into play for our unearned income. So now let's dive into some planning strategies. The other thing that we should probably note at this point is that all of these tax planning strategies that we're talking about today are based on what the current law is. There is a lot of uncertainty with respect to the political landscape now, and as President-elect Trump's tax plans are starting to unroll, we'll have a lot more information as to what needs to be changed. But based on current law, these are the strategies that we're talking about now. If you're concerned about specific things you've seen in the news regarding President-elect's strategies, please feel free to contact us. We can see if we've heard anything or seen anything. But everyone's kind of still getting up to speed on what's going to be in the coming year or years. Okay, so our typical tax planning strategy is really a two-pronged approach, and we do both of these items to really manage what tax bracket we're in. So we are going to accelerate deductions, so we're going to pull as many deductions as we can into tax year 2017 while we're simultaneously deferring income. And that's going to push any income off into 2017. And what that does is that gets your 2016 overall income to the lowest possible number that we can get it, which keeps your 2016 tax bracket as low as we can get it. So how do we do that? For taxpayers that are salaried, so employees, try to manage any year-end bonuses. Taxpayers are going to be on a cash basis, individual taxpayers, and so you're not going to be taxed on the income until you receive it. So if you are due a bonus in December, it may make sense to defer that until the first week of January in order just to keep your overall income lower. We also want to manage our year-end income for cash basis self-employed taxpayers. Now, for a lot of people, they may be wondering, well, how do I actually do that? It doesn't mean that you receive a check on December 31st and you take that check and you stick it in your drawer and pretend you didn't see it until January 1st. That's not really managing our income. What you can do is manage your billing. If you're a cash basis, calendar year, self-employed individual, try to see what billings you can postpone until later early in 2017 to try to really manage that cash flow, but just something to be aware of. So the other side of it is accelerating deductions. So what kind of deductions? We're going to go into each of these specifically, but these are going to be our itemized deductions. So medical expenses, state taxes, interest, contributions, and our miscellaneous itemized deductions. One thing to note, once taxpayers are considered high income, there is a PEAS limitation. So this is an overall limitation on your itemized deductions. The threshold for taxpayers that are married in 2016 is $311,000 and $259,000 for those taxpayers that are single. And what that means is that all of your itemized deductions are going to get a little bit of a haircut. They're not going to be 100% deductible for your tax calculation. So specifically, let's talk about some of these deductions. The first we'll talk about is mortgage interest. So this is interest that is on your primary residence or up to one secondary residence. And in order for this to qualify as a mortgage interest deduction, the lender actually has to have a lien on the home. And as far as the amount of the deduction, the total investment debt for the mortgage interest cannot exceed $1 million. Once your total debt exceeds $1 million, then you'll only be able to deduct a pro rata portion of the interest. So you'll still get some of it, you just won't get 100%. And we can look at all of the mortgages. If you have, more than one home, more than one, vacation home, or more than one mortgage, that the total debt does exceed that $1 million, we'll be able to actually look and pick which mortgage interest deduction would yield the most favorable tax deduction. And that calculation can change from year to year. Once you pick one mortgage, you're not stuck with, only deducting that mortgage for the rest of your life. You can kind of make that determination on an annual basis. So the other item is our home equity interest, and that's going to be on investment or mortgage interest debt of up to $100,000. Again, if you exceed that $100,000 limit, it's just a pro rata calculation. As far as the difference between federal tax and AMT tax goes, the one thing to note with mortgage interest for a home equity line, you need to use the proceeds from the home equity line in order to improve that primary residence or the secondary residence in order for that interest to be deductible for AMT tax purposes. If you take that mortgage interest and go purchase another asset, a car, a boat, something along those lines, you will get a tax deduction for that interest for regular tax purposes, but the interest will be added back for AMT purposes. So it's important to really understand what you use the proceeds for and make sure that your tax advisor is aware of what you use those proceeds for so that the AMT calculation will be accurate. We also still have in the law the deduction for mortgage insurance premiums. So these are for taxpayers that don't have the 20% to put down when they acquire a home and are required to pay mortgage insurance. Those premiums may be deductible. There is an income limitation. Okay, so next we'll talk about medical expenses. This is the first area that we are going to see a floor provision come into play. And so our medical expenses need to exceed 10% of AGI in order to have a benefit. And what that means is that we take our AGI, our adjusted gross income, we multiply it by 10%. Only the amounts that exceed that 10% will be deductible. Anything that's under that threshold does not go anywhere. So one thing to think of with these types of deductions is we want to try to bunch the expenses in 1 year. So we want to try to inflate our medical expenses in 2016 to the extent possible so that we really have the maximum expense in 2016, which would lead us to exceeding the floor in a greater amount. Obviously, we need to be careful here. We never want to let taxes wag the dog. And so if you have a procedure that needs to be completed and it's important from a medical standpoint, we don't want to defer doing it just because we want to save taxes. But if you're talking about some kind of, optional or, cosmetic, something, or not cosmetic, but something that doesn't need to be done now, then you may be able to think about what tax year to take that medical expense in and try to look at your overall medical expenses. It may be worth putting it off until January, again, only if you can. The other thing to note with medical expenses is if you're 65 or older, that floor is 7.5%. So for taxpayers that are older than that age, then the floor just comes down a little bit. Everything we've been talking about so far has been federal-based. The one thing we'll add some color to New Jersey when there is a difference that's really important to note. And one area that is often overlooked by taxpayers is that the New Jersey medical expense deduction is actually more favorable than the federal deduction. And there's the big reason for that is that floor. So New Jersey also has a floor provision, but that floor for New Jersey purposes is 2%. So there's a big difference between 10% of income and 2% of income. And oftentimes we see taxpayers that may not get a federal benefit for medical expenses, but can certainly benefit from a New Jersey deduction because their floor is much lower. The other thing that's frequently missed is on your New Jersey W-2, often New Jersey wages are higher than federal wages. And reason being is that for federal purposes, any medical insurance premiums, they're not taxable. So they're excluded from your federal taxable wages. New Jersey does not allow that exclusion. So they actually add back the medical premiums and tax you as if it's, earned income wages. Because you're paying tax in New Jersey on those premiums as income, you're entitled to deduct them as a medical benefit. So if you look at your W-2 and if you see a difference between your federal and New Jersey wages, it very well may be that there are medical expenses that would qualify as a deduction for New Jersey purposes. So it's just something to take a look for. So next, state taxes. The first thing we'll talk about is real estate taxes. Real estate taxes, this is going to apply to any number of homes that you own. So where our mortgage interest side was limited to a primary and secondary, real estate taxes, you could own 20 homes and deduct the real estate taxes for 20 homes. There's really no limitations there. There is also an income tax or sales tax deduction. So for taxpayers that are in the New Jersey, generally we're deducting income tax because our income tax rate is higher than our sales tax deduction. But if you made a big purchase this year, if you purchased a car or some other large asset, it may be worth just doing a calculation to see if the sales tax deduction would provide a higher benefit. We obviously want to take the higher of the two. But generally in New Jersey, our taxpayers are taking an income tax deduction. One thing to note with income taxes, state income taxes, is as far as the federal deduction goes, we're strictly on a cash basis. So the taxes must be paid in 2016 in order to get a 2016 deduction. Many of you may be looking at this time of year and know you have a fourth quarter estimate coming due. That estimate is not due until January 15th of 2017. If you don't make that payment until 2017, then it won't be deducted until 2017. But the one thing to be cautious about as far as, some of you may be thinking, should I prepay that and cut that check on December 31st to accelerate my deduction? Make sure you're not going to be an AMT. So right now, Karen and I are doing a ton of tax planning for our clients, and one of the main questions we're asking is, should you make an estimated tax payment in December, or should you wait and make it in January? Obviously, we don't want to give anybody their money too early and until it's actually due. So we don't really want to make sure that if we're going to make a state tax prepayment, that there is going to be a tax deduction, a tax benefit for it. Otherwise, we'll just wait till January. So next, charitable contributions. In order for a charitable contribution to be deducted on your 2016 return, you need to have that contribution made by December 31st of this year, so a couple weeks left. One interesting thing that is worth mentioning is that as far as charitable contributions go, if you would like to take a tax deduction this year, you can make that deduction with a credit card. As long as the credit card is charged by December 31st, it will count as a 2016 deduction, regardless of when the invoice is actually paid. And we'll also talk about the next slide, the substantiation rules. And so you're going to see up on the screen, these are all of the specific rules regarding what you're required to maintain in your records. If it's under $249 or less, then you just need to keep written records, canceled checks, any records you can regarding what that contribution was for and where it went. Once you get over that $250 threshold, then the recipient is actually required to send you some kind of backup, some acknowledgement letter. They need to indicate what the total amount of the contribution that they received is, and they also need to indicate if you received anything of value for that contribution. So if it was a dinner and there was, a $100 dinner fee, ticket fee, but 25 of that was actually the cost of the meal, then you can only deduct the $75. You can't deduct the full amount. Unless you didn't go to the dinner, then it's obviously a different story. And this is worth mentioning, just the substantiation rules in general. It's critical that you keep good records for all of your personal and business tax needs. Karen and I have had a few cases this year that we've worked on with clients, and a lot of audit issues really come up with respect to substantiation. And we've seen them go both ways. Some where we had, good tax deductions that were lost simply because there was no substantiation to back it up. And the other side of the spectrum is a taxpayer that has immaculate records and, can go through an audit without any changes to their taxable income because they were able to provide the support. So make sure that you are really cognizant of substantiating any deductions that you have. Okay, so now we're going to go into our second polling question. And the question is, taxpayers do not have to worry about keeping records of their charitable contributions. This is a true or false question. Again, if you are looking for CPE today, then we're going to need you to participate in this polling question. We'll give you guys a minute to get your answers in. Okay, we're going to close that poll up, guys. And obviously, we just had a discussion about this. It's important that you keep all of your records, certainly with respect to charitable contributions. So another topic, continuing on the topic of charitable contributions, we also can, in addition to giving cash, we can give non-cash items. One popular method of doing that is securities. And so there's a few planning tips that we can discuss with respect to this strategy. The first, if you are holding on to appreciated securities, so you're looking at your portfolio and you have stocks that you own and you're looking at a taxable gain, what you want to do is actually transfer the security to the charity. And that really gives you two big benefits. First, you don't have to pay tax on that gain. So now you've saved yourself the 15% or 20%, whatever your capital gain tax rate is, automatically. The other thing you do is you get a fair market value charitable deduction for the contribution of that security. So it's a really great strategy for taxpayers that are charitably inclined to really see two benefits at once. Now, the other side of it is if you're looking at your portfolio and you have depreciated securities, so you're looking at a loss position, this is a situation where you're going to want to actually sell the security and then transfer the cash to the charity. And again, we want to have both sides of the fence accounted for. And in this case, we can actually take that loss and take that tax deduction while also still having a fair market value contribution deduction. So when you're making charitable contributions, just be really aware of what your position is, whether you're looking at a gain or a loss, because that really would impact how your strategy is with respect to the donation. Also, this bullet, you can also deduct any expenses. So if you're a volunteer and you have out-of-pocket expenses, those count as qualified charitable contribution deductions. The other thing to note on this slide are tax-free distributions from individual retirement plan. This is something that was written into law a few years ago, and now it is permanent. You can exclude up to $100,000 of income if you're required to take distributions from your IRA. Instead of taking the distribution yourself, you have the IRA custodian transfer, whatever amount you decide directly to the charity, and this keeps your overall income low, which helps with, various other tax planning strategies. So it's a really good tool if you're considering doing it, and, if it might be beneficial to you, please give us a call and we can help you navigate that decision. Next, we'll talk quickly about donor-advised funds. So donor-advised funds are a really great tool for taxpayers that are charitably inclined and have income that isn't necessarily even from year to year. It's really most beneficial to taxpayers that have some unusually high income in a particular year. And a donor-advised fund is actually a 501c3 organization. It's managed by your big brokerage banks. So Fidelity, Merrill Lynch, they all have these donor-advised fund type strategy options. And you actually make the contribution into the donor-advised fund. It's, your specific funds. They're set aside in an account for you. And you get a tax deduction in the year that you actually make the contribution to the donor-advised fund. The donor-advised fund then, takes those proceeds and invests them. And as you want to fulfill your charitable obligations or whatever your charitable desires are, you actually have the donor-advised fund write the check to the American Cancer Society, Red Cross, whatever particular organizations you prefer. The time limit for getting the funds out of the donor-advised fund, there isn't any. So for a lot of taxpayers, what it allows them to do is get a really large tax deduction in a year that they have an unusually high amount of income, while spreading their charitable contribution obligations over several years. So it's really a great tool to get big tax savings at high income tax rates, while not giving all of the money to charities right now, today, really spreading it out over several years. And again, this is everything that we've just talked about in the prior screen. So our last itemized deduction we'll talk about is our miscellaneous itemized deduction. And this is going to be our tax prep fees and any tax planning fees that you're paying to your CPA. That's all a miscellaneous itemized deduction. Any investment advisory fees qualifies, and those unreimbursed employee business expenses. This is the next area that we're going to see this floor provision come into play. So in order to have a benefit for these deductions, they need to exceed 2% of your adjusted gross income to have a marginal benefit. One thing to keep in mind is that these items are disallowed for AMT purposes. So this is one area that you may not necessarily see a tax benefit, tax savings, if you are an AMT. Okay, so next we'll get into some gain loss management strategies. So the first thing we can do is we can harvest capital losses to realize offset our realized capital gains. So if you're sitting, now on December 8th, and you see that you're in an overall capital gain position this year, you can sell some securities if you're looking at your portfolio that are in a loss position. And what that's going to do is really neutralize that gain so that you don't have any tax impact on that gain. The important thing to note when we're harvesting capital losses is that there are wash sale rules. And what the wash sale rules say is that there's a 30-day look-around period from the date you sold that particular security at a loss. And if in that 30-day look-around period, so either before or after that date of sale, if you reacquire that stock, then the loss is going to be disallowed until you ultimately sell the stock. So really be careful if you're trying to implement this strategy. Make sure that if it is a security that you decide to repurchase, that you wait until that 31st day in order to implement the sale or implement the buy. Otherwise, you'll have a capital loss that won't be deductible. Now, the other side of this is we can harvest our capital gains to neutralize our capital losses. So this means that you are sitting in the end of the year and you're at an overall loss position. And what you would do is you would sell securities to bring your capital loss up to zero. And this is really beneficial for New Jersey taxpayers in particular because New Jersey does not have a carry forward provision. The federal government, if you're in an overall loss position, you can deduct $3,000 a year against ordinary income until the entire capital loss carry forward is utilized. New Jersey has a use it or lose it principle. So once you have a loss and there are no gains to kind of suck up that loss, it's completely lost for New Jersey purposes. So this is why this is a critical strategy for New Jersey residents. The other thing to note is as far as harvesting capital gains rules, there's no wash sale rules. So if you do have this situation where you have a capital loss but you also have some gains that you can harvest, it may make sense to sell the security just to harvest the gain. It'll neutralize your tax position and you can immediately repurchase that security. And basically all you've done then is you've stepped up your basis in the stock. So it's a really nice tool for taxpayers in New Jersey especially. Okay, so gain loss management. The next couple slides we're going to talk about some specific provisions relating to investment. And so Section 1202 was written into the law to really promote investment in small business. So this is going to qualify for original issue C corporation stock. And what Section 1202 says is for non-corporate taxpayers, they can exclude 100% of the gain. So there is zero income tax on the gain for certain small businesses whose stock is required after December 31st of 2014. Again, it has to be original issue and it needs to be held for more than 5 years. And this 100% exclusion is for stock that's acquired after December 31st, 2014. For stock that's acquired before that, there is a 50% exclusion. There's a 75% exclusion. It really depends on the year that the stock was acquired. So just something to be aware of. It's a really great tool. And the other thing it's really impacting our taxpayers and their decisions on what type of entity they're going to create. So if you're starting a new business, typically people have been favoring LLCs the past several years, but Section 1202 is really having a lot of taxpayers rethink, does an LLC make sense with this 1202 provision? It may make sense to be a C Corp. Because if you're, obviously you're going into business, you hope that it excels and it does well. And 100% gain exclusion on a sale is obviously very enticing. So the reverse to Section 1202 is Section 1244. So again, we're going into a situation making an investment, and we hope for the best. Obviously, things don't always go as planned, and sometimes we're in a loss situation. So for those Section 1202 gains that we would have, the answer to that is Section 1244. And what this says is typically these investments in these C Corps and these new ventures would be investment and therefore capital in nature, and there would be a limitation. So you'd only be able to deduct $3,000 against your ordinary income. What 1244 says is up to $50,000 for single taxpayers or unmarried taxpayers, and $100,000 for married taxpayers can actually offset other types of income. So it would be an ordinary deduction, which is obviously a much better situation than a capital loss. Any loss that's in excess of that $50,000 or $100,000 threshold, depending on your marital status, is treated as a capital loss. So you still get the full benefit, but the first $50,000 or $100,000 would actually be a more tax favorable loss. And again, these two provisions were written into the code to really encourage people to make investments into new ventures. The last thing we can talk about with respect to gain loss management is going to be our worthless stock. And as far as worthless stock goes, it's a very gray area as to when the stock actually becomes worthless. It may be evident to everybody that you're definitely holding a worthless obligation, but actually pinpointing the date of worthlessness is a little difficult to prove. It's a very gray area. But there needs to be some event, something needs to happen that really solidifies that this investment is worthless. It could be a bankruptcy, there's a whole bunch of options that could really solidify this, but again, it's a gray area. So the one thing that we like to advise our clients to do is take any of that gray area away. Sell the worthless stock to a third party for $1. Now you've actually initiated a sale or exchange of that stock, and there is no more gray, and you've actually secured that loss. So just be aware of the rules if you are trying to take a worthless stock deduction or loss, and you may want to actually make that sale to take any gray away. 1031 exchanges. These are like-kind exchanges, so these are going to be for investments or rental properties, and this is when you actually have an investment or rental and you exchange it for another investment if you were holding an investment, or another rental if you were holding a rental. And this is a gain deferral technique. It allows you to take the gain from the original investment or rental property and just really roll that into a new property. So you take one property and exchange it for the other, and you defer any gain being taxed as income until you ultimately sell that second property. The most important thing to discuss with respect to like-kind exchanges are the rules are very, very complicated with respect to these transactions, and they need to be done in a very, very specific manner. And so it's important that if you're considering doing a like-kind exchange, that you hire a qualifying intermediary to actually handle the transaction, and this should be done before you enter into transaction. You can't take any cash directly for the sale, otherwise the like-kind exchange won't be considered qualified and you'll actually have a taxable gain. So just be very careful and make sure you hire the right professionals to help assist you with these types of transactions if you're considering them. And installment sales. So this is a situation when you sell a property in year one, except the proceeds are not received all in year one. They're spread over the life of the sale terms. And so in the simplest example I could give you, you have a gain of $100,000. And half of the proceeds are received in 2016 and half of the proceeds are received in 2017. The gain is actually going to be split 50-50 based on the year it's actually received. The installment method is mandatory unless you elect out of it. So the nice thing with installment sales is you can really spread your income and keep your overall, taxable income down, which keeps your brackets down. It could keep you out of the net investment income tax. So it's a really nice tool if you are in a position that you're offered an installment sales setup. A lot of times there are some tax benefits to using these types of transactions and using the installment method. So net investment income planning, one of the things we just talked about was using installment sales. We want to try to limit the impact of the Medicare Surtax wherever possible. We've seen a lot of taxpayers really shifting their investments. So instead of having income funds, they're shifting to growth funds. So instead of having dividends being paid out every year, you're looking more at the long-term growth of an investment. We've also seen a lot of shifts in overall portfolio management, so going from taxable bonds to tax-exempt bonds. Items that are tax-exempt for regular tax purposes are also tax-exempt for the net investment income tax purposes. So it's a great tool. So next we'll talk quickly about some retirement contributions. So we have our 401k contributions, and then we have a few types of IRAs we'll highlight. So our 401ks, these are going to be our employer-sponsored plans. The elected deferral limit is $18,000 this year. For taxpayers that are over age 50, there's an additional $6,000 catch-up contribution allowed. Next, we have some IRA limitations. These are going to be the same for all of the IRAs that we're going to discuss. So it's $5,500 a person in 2016. If you are over age 50, then there's also a catch-up. It's $1,000 in 2016. The nice thing about IRA contributions is that in order for you to receive a 2016 tax deduction, the contribution has to be made by April 15th of 2017. So you get a little bit of extra time if you're considering making a deduction or making a contribution into your IRA. You can actually have it count for 2016 without actually needing the cash until April 15th of 2017. So our traditional deductible IRA, these are one of the most common forms of IRAs, something that most people are probably familiar with. This allows you a tax deduction today, and you pay tax when the funds are distributed in retirement. If you're covered by an employer retirement plan, then you're not allowed to make a traditional deductible IRA contribution, okay? A traditional non-deductible IRA, this is an IRA where you do not get a tax deduction today, and you pay tax on the increase in value when the funds are actually distributed in retirement. The important thing to note with non-deductible IRAs is that you really need to keep track of the basis of these contributions. Reason being is you did not get a tax deduction when you made the contribution into the plan, and so you want to make sure that you don't pay tax twice when the money is coming out. The IRS offers a tool for this. It's a Form 8606. Once you file an 8606 with your tax return, you need to attach it every year for your life, just to make sure that you keep track of that basis. A lot of people kind of look at you and ask, well, if I'm not getting a tax deduction today and the treatment is the same, what's the point of these plans? Why do I do it? And the point is really tax deferral. So if you make a contribution today, the funds really sit in that retirement plan and they can grow in value, and you don't pay tax on that growth until the money is actually pulled out in retirement. Okay, so we're going into our last polling question. And the question is, taxpayers have until April 15th of 2017 to make an IRA contribution for the 2016 tax year. So we'll give you just a minute to get this answered. I think we're going to close it up, guys. Okay, and yes, the answer is you do have until April 15th of 2017 to make that contribution. So the last IRA we're going to talk about is our Roth IRA. And so these IRAs, you do not get a tax deduction today, so when you make the contribution, no deduction. But the funds grow and earn money for your career, and when you're actually in retirement and taking the funds out, you pay no tax on what was put in because you were already taxed on that, but you also don't pay tax on any of the appreciation. So this could be really, really powerful for taxpayers. We see this most commonly with our younger taxpayers. They really, at this point, are generally in a lower tax bracket, and so to forego a deduction today at a 10-15% tax bracket isn't generally a big tax cost. Especially when compared to the benefit of having that plan grow tax-free until retirement. Taxpayers that can make a Roth IRA, again, all of these are really limited by AGI, so not everybody can do this type of plan. And Roth IRA conversions. So these are for taxpayers that are making traditional deductible or non-deductible contributions and then actually converting that plan into a Roth. And the year that you make the conversion, you actually pay tax on the value in that year, and then from that point forward, the plan grows tax-free. Whether or not to actually do that conversion is a very complex analysis and requires a lot of planning. But consider the valuation's low. Remember, you're going to be paying tax based on the value of that plan today. So if your overall portfolio is down, it may make sense to take the tax hit now and really do that Roth conversion now. So there's a lot of things to consider with respect to these conversions, but for a lot of taxpayers, it's a really good tool to do a conversion and really take the benefits of the tax deferral. So quickly, we're rounding the end of the individual tax side, and these are just some important credits or other tax-saving options that we wanted to highlight. We're not going to go into detail on any of these, but a child independent care credit, this is if you're outgoing and working, there may be a credit eligible to offset those costs. Child tax credit, this is just for having a child. There's a dollar value, on a per exemption basis. And then there's a bunch of education credits and benefits. A lot of these are based on income, and so it's important to really look at a family structure as a whole. You personally may not be able to benefit because your income is higher, but you may have a child that can benefit if they're working. They just have to forego their dependency exemption. So we really like to look at the family unit as a whole to make sure that the family unit as a whole is in the best possible tax situation. Savers credit is to encourage individuals to save for retirement. Adoption is for taxpayers that are incurring adoption expenses. The Section 121 benefit, this is for taxpayers that are selling their primary residence. If you're selling your primary residence and it's been your primary residence for 2 out of the past 5 years, and you're selling it again, up to $500,000 for married taxpayers is actually excluded from your income if you qualify. So that brings me to the end, and now I'm going to turn it over to Karen to take into business tax planning.
Thanks, Lauren. So most of what Lauren has talked about for the past 30 minutes or so has dealt with you as an individual taxpayer. And while there's not a lot of loopholes or any good loopholes left for business taxpayers, for those of you that are self-employed, I'm going to talk for the next few minutes about a couple of areas where there are opportunities for you to save some tax dollars. The first one that we're going to talk about deals with fixed assets and capital expenditures, or CapEx. So Lauren mentioned quite a bit the term cash basis taxpayer, and real quickly what that means is that in order to get a tax deduction, you have to spend the cash. In the case of fixed asset acquisitions and CapEx, we don't get that benefit. The IRS tells us, generally speaking, that when you purchase an asset that has a useful life of greater than 1 year, we have to spread that deduction out over the useful life of the asset. The IRS goes further to define for us what the useful life is through tables. So as this example shows, if we spent $1,000 on computers, we're not going to be able to take that $1,000 expense in the year of purchase. We would instead have to spread it out over 5 to 7 years. So the business will be out of cash in year 1, but they're not going to get the full benefit for several years. The other piece with depreciation that we have to keep in mind is that in order to be eligible to even claim a depreciation expense, that asset physically has to be placed in service by the end of that tax year. So here we are sitting, it's December 8th, and we have a few weeks left. And one of the things that we're talking about with our clients is whether or not we should go and spend money before the end of the year on equipment, that they may need. So, the discussion really focuses on whether or not it's realistic that they, purchase the assets, receive the assets, have them delivered or whatever, and that they're actually installed. So 2 quick examples. In the case of computers or, furniture, office furniture and stuff, you can order that and have the stuff shipped to your office, and on December 30th, unpack boxes, plug the computers in, put them on your employees' desks, turn them on, and those assets are placed in service and they're eligible for depreciation. As opposed to a manufacturer or a dentist, in the case of a self-employed individual who's going to purchase a dental chair. If you go and order that piece of equipment now, the likelihood that you're going to have it shipped, unpacked, and then installed, because there's a lot of plumbing and wiring and a whole lot of other stuff that needs to be done. It's not as simple as opening a box and turning a computer on. So if you buy something now and it's not placed in service until next year, your ability to claim any benefit from that expenditure is going to be delayed until next year. Now, as with every rule, there's exceptions. So we're going to talk about 2 exceptions. The first one is Section 179. So Section 179 is a provision in the code that's been around for many, many, many years. And it basically says that for qualifying purchases, you can write off in the year of acquisition as long as the asset is placed in service. This is something that for a number of years recently has kind of been, on the slate this time of year to not be extended. But now there's an enhanced provision, which I'm going to talk about in a second, that it is permanent. So initially when Section 179 was written into the law, business taxpayers were allowed to write off $25,000 of new purchases in the year that they acquired them. That has since been expanded to $500,000. So there's a couple of limitations with Section 179. The first one is that if you place more than $2 million of property in service during the taxable year, your deduction, that maximum of $500,000, is going to be phased out. So you can you can claim an expense of up to $500,000 in a year as long as your total qualifying purchases placed in service don't exceed $2 million. The second limitation deals with taxable income. So if you are, say, a dentist, as an example, and your Schedule C, which is a schedule that you would file as part of your 1040, shows, a $20,000 loss prior to claiming any depreciation, you wouldn't be able to claim any Section 179. So you can claim Section 179 to reduce your taxable income to zero, but you cannot use Section 179 to create a loss. So to the extent that you elect this, because this is an electable provision, any excess that you elect would be carried forward to future tax years and would be factored into the limitation in those future years. The second exception is bonus depreciation. And bonus depreciation came into the law after 9/11 as a way to stimulate the economy. So Congress passed the bonus depreciation provision, which basically said that you can write off up to a certain percentage of qualifying asset acquisitions during the year. So it's similar to 179, but I'm going to explain the differences. It started off as a 30%, initial immediate write-off, and then it went up to 50%. For a number of years, it was at 100%, and now it's back down to 50%. And as the slide shows, it's going to be phasing out over the next couple of years. So we're 50% through tax year 2017. It's going down to 40%, 30%, and then it's gone after 2019. So the differences between bonus depreciation and Section 179 are twofold. Bonus depreciation can be taken in situations where you have a loss, whereas Section 179 cannot. The second biggest difference is that bonus depreciation is only eligible for property that is new. So the first use of that property has to start with you. Section 179 can be used for new property or also used property. So if you go and buy a used truck for use, in your construction business, that would be eligible for Section 179, but not bonus depreciation. Another provision is typically, let me take a step back and explain the depreciable lives. For the most part, as small business owners, you're going to see your fixed asset purchases are going to be depreciated over 5 years or 7 years. If you happen to rent space, in a building somewhere, and they're going to, do a fit out for you, those improvements are going to be treated as leasehold improvements and considered realty for depreciation purposes. And typically, commercial realty would be depreciated over 39 years. So there is really no incentive there to, do any improvements to any type of office space. However, there has been, recently, they have come up with this term called qualified leasehold improvements, and this benefits many businesses and restaurants and retail establishments as well, where depending on the type of improvement that's being done, instead of being stuck with a 39-year depreciable life, we can take those depreciation deductions over 15 years. So what is a qualified leasehold improvement? Qualified leasehold improvement is an improvement that's made pursuant to a lease to the interior portion of a building where the building is greater than 3 years old. Doesn't mean that you have to be in that space for 3 years, but the building had to have been in service for 3 years. And the lease is not between related parties. So what does this do? It shortens our depreciable life, and on top of that, those qualified leasehold improvements are eligible for bonus depreciation. So you would get to write off 50% of the cost of those improvements and then depreciate the balance, the other 50%, under the regular rules. And that holds true for any asset acquisitions that you're claiming bonus depreciation on. You would get to depreciate the balance over the regular useful life. And the last area where we see some opportunities for business owners is in the retirement plan arena. So So Lauren talked a lot about, retirement plan contributions from the individual level. So now I'm going to, add some color to that and talk about it from the business owner standpoint. So wouldn't it be great if, we could claim a tax deduction, for $1,000 and have the majority of that $1,000 come back to us in our own pocket? And a retirement plan is one of those areas. Now, it may not be dollar for dollar, but the theory is that depending on the type of plan that you set up and how much cash flow you have and what your long-term goals are, you can have a plan designed for you where you can make a contribution of, say, $50,000, and the majority of that $50,000 would come back to you in retirement. So you get a tax deduction today, and you'll get that money back when you retire. So, 401k, the trick with the majority of these plans is that they have to be established prior to the end of the year. So you can't decide on April 15th when you're filing your tax return and you look at your business income, you can't say at that point, oh, gee, I want to set up a retirement plan, and make a contribution for my employees as well as myself. It doesn't work that way. So the most common one that we see is a 401k, and there's usually a profit sharing plan that's attached to that 401k. So any individual, the maximum retirement plan contribution that you can make into a qualified plan is $55,000, I believe, for 2016. But that, along with the ability to make that contribution, you cannot discriminate against your employees. So that's the key. And for all of these plans, you would want to consult with a retirement plan specialist who can sit down and help you run different models to figure out what works best for you. The other benefits of setting up retirement plans are that while I said that the plan has to be established by the end of the year, you don't necessarily have to fund that plan until the extended due date of your tax return. So if your return is due April 15th, which for all individual taxpayers it is, you can get a 6-month extension until October 15th, and you would get that extra 6 months to actually put the funds into the retirement plan and claim the deduction on your 2016 return. So, if that's something where you're looking to, benefit your employees, help with loyalty, morale, so on and so forth, and stock away a lot of money for yourself in retirement over and above, what a regular IRA contribution would be, this is something that you should absolutely consider. Before we wrap up, I guess, this is what Lauren had mentioned before, is we have a change in regime in Washington, and while there's nothing set in stone going forward, we're pretty sure, just based on what we've heard and seen, with Trump's tax proposals and everything, that there's going to be likely to be some pretty substantial changes. There's nothing in place now. However, so all of the planning and the advice that we're giving now are really based on what we do know. We generally don't like to, go based on what we think is going to happen, because we have no idea, and we could really, cost taxpayers and our clients some big dollars if we say, hey, let's defer all of our revenue and stuff like that. But the point is that there are, a lot of changes on the horizon. So you should be talking to, your accountants now this time of year, just to see if there's anything, that you should be considering when trying to come up with some tax planning strategies for the end of the year. So stay tuned, and I'm sure next year we'll have a lot to talk about. So just thank you for joining. We do have one question. The question is 2016 415G 53,000 not including, okay, so I stand corrected. I thought it was 55. It's 53,000. So thank you for that. And I think, unless there's any other questions, I guess we're going to wrap up. And as I said earlier, you'll get your evaluations. Please be sure to return that to us, and we'll send your CPE certificates. And if you enjoyed the webinar and you want to share the link, with other colleagues or friends, it will be available for download within the next week or so. Thank you.